Today's forecast reflects changes from the last forecast that we issued on February 28th. It reflects legislative changes, revenue and spending changes, and economic changes. Our forecast reflects current law. The budget deal reached in the last legislative session covers the current biennium that began on July 1, 2019. We are now almost 6 months into the current biennium. For some context, we now have had 12 surpluses out of the previous 13 forecasts. The last 7 years of surpluses follows a series of deficits that occurred leading up to 2011. But before we go into further details, I want to share some especially good news. Minnesota's budget reserve target has been reached. It is now $2.359 billion. Budget Director Reitan will describe in more detail the math involved. But you may recall that in 2014, Governor Dayton and the legislature enacted a law that requires 33% of any November forecast balance to be automatically allocated to the budget reserve. Since enactment of this budget reserve law, today is the first time that we reached the budget reserve target. We achieved this milestone through an unwavering focus on sound fiscal management. A full budget reserve means our state is better prepared for the next economic downturn. Just a reminder that the budget reserve and the cash flow account of $350 million together make up our rainy day fund, and now is a total of $2.709 billion. During the past 20 years, we have seen the importance of a budget reserve when unexpected revenue declines or spending increases occur. In the aftermath of the recent recession, over 70% of states reported using their rainy day funds to address budget gaps, according to the surveys by the National Association of State Budget Officers. Budget reserves reduce the need for large immediate spending cuts or tax increases, giving many states the time they need to consider ways to maintain needed services despite depressed revenues in an economic downturn. According to the Center for Budget Policy Priorities, states with rainy day funds were able to avert over $20 billion in cuts to services and/or tax increases in the recession of the early 2000s and again in the most recent recession. Without an adequate reserve, we had to cut quality services in Minnesota while the needs continued to grow, and we had to delay payments to schools and local governments as part of our workout process. We were not prepared for the last recession. But with our sound fiscal management, we have learned from our mistakes and are better prepared for the next one. A full reserve is not only an important element of Minnesota's preparation for an economic downturn, it is also a key credit factor that rating agencies use to determine financial stability in awarding Minnesota its AAA credit status. Rating agencies want to be sure that AAA states can weather an economic downturn. Experts across the nation see our budget reserve policy as sophisticated and fiscally sound. In fact, Pew Charitable Trust ranked Minnesota 12th in the nation for being able to cover spending with dedicated savings from a rainy day fund and called us a leader among states. Hitting this budget reserve target today is an accomplishment that all Minnesotans can be proud of. And I want to give credit to the people of Minnesota who make their home here, who invest in this state both for their businesses and for their families. Job well done. It is all of you and your hard work that make this state so special. Well, I'm going the wrong way. Now for the details, and as MMB we call this the fun part of the forecast. This morning we will be able to explain the changes that have occurred over the last forecast. As I mentioned, the projected balance of $1.332 billion for fiscal years 20 and 21 has grown because of increasing revenues and a small decrease in spending. Budget Director Reitan will explain expenditure changes and the contribution to the budget reserve. Dr. Kalambokidis will describe how the economic outlook has changed since last February and explain our increased revenue projections. As always, there are risks to this forecast, to any forecast. We will also explain those risks. Budget Director Reitan.
Good morning. My name is Britta Reitan, State Budget Director, and I'm going to walk through the current biennium's balance. If you look at this slide, this shows the change in the budgetary balance in fiscal years 20 and 21. And the slide is comparing the end of session estimates to the estimate in this forecast. The right-hand column reflects the change between the end of session and the forecast. The bottom row of the chart shows the budgetary balance, and in the middle column, you can see the $1.332 billion in budgetary balance we have for fiscal years 20 and 21. This is an increase of $1.09 billion over end of session estimates and is after the allocation of additional funding to the budget reserve. The biggest driver of the change is $891 million in increases in the beginning balance. So you can see that on the bolded top line, the beginning balance is increasing. And what that means is that more money is rolling forward or carrying forward from the close of fiscal year 19 than we previously projected. Of that $891 million, the majority is due to higher total revenues than previously forecast for FY19. Revenue projections are also increasing in the forecast for the current biennium by $501 million, and expenditure estimates have declined only slightly by $7 million overall. And we'll talk more about the drivers of the changes in the expenditure and revenue forecast in some later slides. The next line shows the change in the budget reserve. Under existing statute, 33% of the balance, or the amount necessary to reach the target, is deposited into the reserve. And as the commissioner mentioned, with this forecast, we do in fact reach the budget reserve target. So $284 million is added to the reserve, which brings us to $2.359 billion in the budget reserve. The next line shows $350 million in our cash flow account, and that remains unchanged with this forecast. And then the line below that shows the change in our stadium reserve. This balance is projected to increase by $25 million compared to the end of session estimate, and it's due to increases in gambling tax revenue since our end of session and February forecast estimates. And again, the budgetary balance for this biennium is projected to be $1.332 billion. So moving to the next slide, this just provides a bit more detail about the allocation to the budget reserve and the calculation that we use. The budget reserve law that was passed in 2014 establishes a reserve target that is annually determined by MMB, and it's work done by Dr. Kalambokidis' team, where they evaluate the volatility of Minnesota's revenue system and determine a reserve target. So the reserve target is a percentage of biennial revenues. It's not a static dollar amount. It's a percentage of biennial revenues. So as those revenues change, the dollar amount of the reserve target also changes. And currently, our budget reserve target is 4.9% of biennial revenues, which given our current revenue projections is the equivalent to the $2.359 billion. Before the allocation to the reserve, the balance in the reserve was $2.075 billion, meaning we were $284 million away from that reserve target. So our statute allows that as we have balance in a current biennium, we either allocate 33% of that balance to the reserve or an amount up to the reserve target. So our general fund balance prior to the reserve allocation was $1.616 billion. 33% of that balance would have been $533 million. But because we reached the target amount at $284 million, that is what was put into the reserve with this forecast, which brings us to a reserve of $2.359 billion. And now I'll pass it to Dr. Kalambokidis to walk through the economy and revenue changes.
Great. Thank you. Good morning. I'm Laura Kalambokidis, State Economist. So I will start by talking a bit about the outlook for the United States, and then I'm going to move to Minnesota's economy, and finally to changes in our revenue forecast. So this first chart compares the current U.S. real GDP forecast by Minnesota's macroeconomic consulting firm, IHS, to their prior forecast in February. The dark bars show the history and the current forecast for November 2019, and the light bars show their February 19 outlook. So focusing on the right-hand side of the chart, on years 2019 to 2023, You can see that the outlook for U.S. economic growth this year has slightly weakened, and the outlook for the remaining years of our forecast have improved since our forecast was last prepared in February. Lower actual growth through most of this year led IHS to lower their expectation for 2019 growth from 2.4% in February's outlook to 2.3% now. Their outlook for growth in each year from 2020 to 2023 is a bit higher than in February, driven primarily by a stronger consumer spending forecast. If you look at the current forecast for 19 to 23, so again on the right-hand side of the chart, and if you specifically look at the dark bars on the right-hand side, which is our current forecast, you can see that the pattern of slowing growth through our planning horizon carries over from the prior forecast. The slowdown occurs as the contribution to growth from federal fiscal stimulus declines, tariffs and trade policy uncertainty undermine business investment, interest rates rise, and growth in household wealth slows down. After mid-2020, a decline in the U.S. labor force participation rate due to an aging workforce further slows the economy. The downshift continues with annual real GDP growth expected to decelerate from 2.9% in 2018 to 1.5% in 2023. The history on the chart, so the prior years, the years since the Great Recession up to 19, illustrates one of the risks to this forecast. The dotted line shows the average annual real GDP growth for the 20 years prior to the Great Recession, 3.1%, which is much higher than what is in our current forecast. And when the economy is growing slowly, there's not much margin for error. It's harder to recover from a setback than when growth is higher. And the U.S. expansion is now the longest on record. A mature, low-growth expansion is particularly vulnerable when negative shocks occur. The relatively small changes in the U.S. GDP forecast are the result of some offsetting changes in the forecasts for GDP components. Specifically, a stronger forecast for consumer spending offsets lower expected growth in business investment. So this chart shows the forecast change for U.S. real consumer spending. The gray bars show the February outlook, and the dark bars show the current outlook. Consumer spending constitutes about 2/3 of real GDP, and IHS expects consumers to remain the primary contributors to growth in the economy. IHS has raised their expectations for real consumer spending growth by between 0.4 and 0.8 percentage points in each year of the forecast, and this influences our forecast for sales tax receipts. The stronger forecast growth is supported by rising incomes, falling gas prices, a lower interest rate path, and rising household wealth. When wealth grows, for example, from rising home and financial asset values, consumers tend to spend more. That positive wealth effect has been an important contributor to economic growth through this expansion. But it is at risk if wealth declines or if policy uncertainty makes consumers jittery. The stronger forecast for real consumer spending offsets a reduced forecast for business investment, so business purchases of equipment and structures and intellectual property, which has been encumbered by a slowdown in manufacturing, including declining manufacturing employment at the U.S. level, a strong U.S. dollar that dampens demand for exports, and trade policy uncertainty. Not knowing what the future trade policy playing field will look like makes business owners postpone expansion plans and hold off on investment. This chart compares Minnesota's labor market to the United States. The chart shows the headline unemployment rate. The dark line is for Minnesota, the light line is for the US. The vertical gray bars show the US recessions, and so the white space between the bars show the recovery and expansion periods. Minnesota's steady economic performance continues even as the U.S. expansion has surpassed record length. Throughout the expansion, Minnesota has steadily added jobs, driving the state's unemployment rate well below the U.S. rate. Minnesota's unemployment rate reached an 18-year low of 2.8% in June 2018. It began gradually rising a year ago, reaching the current rate of 3.2%, 0.4 percentage points below the U.S. rate. The recent increase in Minnesota's unemployment rate coincides with an increase in our labor force participation rate, which is the share of the over 16 population that is either working or looking for work. Our labor force participation is consistently well above the US and among the highest in the nation. But since December 18, it has inched even higher to reach 70.3%, which is 7 percentage points above the US and the second highest among US states. Coincidental upticks in the labor force participation rate and the unemployment rate suggest that some new workforce entrants may not have immediately found work. Creative efforts to match them to jobs will lower our unemployment rate and support employment growth. This chart illustrates Minnesota's tight labor market. The gray bars show the number of unemployed people in the state, and the dark bars show the number of job vacancies. In the height of the gray bars, you can see the peak of unemployment during the recession, and then that steady job growth during the recovery and expansion period gradually whittled that number down. The dark bars show that job vacancies statewide have grown to a very high level. For the past 2.5 years, the ratio of unemployed persons to job vacancies statewide has been less than 1, meaning that there are fewer unemployed job seekers than open positions across the state. And the ratio is now down to about 0.7. The tight labor market is being felt across Minnesota as both the Twin Cities and Greater Minnesota have fewer unemployed persons per job vacancy. The large number of open positions across the state illustrates a strong demand for labor, and we expect that demand to persist as long as the US expansion does. But baby boomer retirements have made it difficult to match that demand with increased labor supply. So recent increases in migration to the state have come at the perfect time and represent a bright spot for Minnesota's economic outlook. For the last 2 years, 17 and 18, Minnesota has attracted more new residents than we lost to other states, reversing a 15-year trend of negative domestic net migration, and making us an outlier in the Midwest. Newcomers from around the country and around the world made 2017 the largest year for net migration into Minnesota in nearly 3 decades. Moving to the revenue forecast. As you heard from Budget Director Reitan, total general fund revenues for the current biennium are now forecast to be $501 million more than the February forecast, adjusted for law changes. Higher expected individual income, sales, and other tax revenues more than offsets a lower forecast for corporate tax revenues. The largest dollar amount change is in the individual income tax, which is forecast to generate $493 million more in the remainder of FY 2020-21 than we had estimated in February. As you heard again from Budget Director Reitan, we ended fiscal year 19 with more income tax receipts than we had forecast, indicating higher tax liability for tax year 18, the base year of this forecast. The higher base plus stronger forecast growth in non-wage income raise the income tax forecast. General sales tax revenue in the current biennium is now forecast to be $252 million more than the prior estimate. The increase reflects higher than expected receipts so far in fiscal year 20 and a higher forecast for taxable sales compared to February. That higher forecast for taxable sales is consistent with the higher US consumer spending forecast I showed earlier. The corporate franchise tax is now expected to generate $294 million less than the prior estimate. The reduced forecast reflects receipts so far in fiscal year 20 that are below our forecast and a lower forecast for corporate profits from the macroeconomic consulting firm. Let me conclude by drawing your attention to some of the risks to the forecast. I mentioned the risk that consumers, the champions of this economic expansion and the main source of sales tax revenue, the risk that they get spooked by policy uncertainty or negative wealth effects and hold on to their wallets. This forecast incorporates all US tariffs and other countries' retaliatory measures that have been put in place to date, as well as the December 15th step in US tariffs on Chinese imports. But as you know, US trade policy, especially regarding China, but also with other trading partners, has been in flux. Uncertainty imposes costs on businesses that have to address supply chain disruptions. Businesses already appear to be putting investment plans on hold, and prolonged uncertainty will exacerbate that slowdown. On the other hand, Complete alleviation of trade policy uncertainty is a source of upside potential to this forecast. Geopolitical events can derail global growth that is already showing signs of slowing. For example, if the UK exits the EU without an agreement, a disruption to exports could follow. Finally, with 19 months before the end of the current biennium, even small changes in assumed growth rates, in particularly volatile income sources such as capital gains or corporate profits, could materially alter the budget picture through our planning horizon. I will now turn it back over to Budget Director Reitan.
So moving to the expenditure side of the forecast, as I mentioned before, this side of the forecast shows very little change overall since the end of session, an overall reduction in spending of just $7 million. There is, however, more significant change in specific bill areas that offset each other. In E12 education, spending is $24 million below end of session estimates. The biggest drivers of the change include a $30 million reduction in general education spending compared to previous estimates, and this is due to a decrease in projected pupil growth, as well as a $16 million reduction in special education, and this is due to slower than projected growth in district spending. These reductions are partially offset by $30 million in additional spending for state safe schools programming. The 2019 legislature made this funding contingent on the FY19 closing balance being above what was projected at the end of session. And as mentioned earlier, that was in fact true, which triggered the contingent appropriation of $30 million for safe schools. Moving to the property tax aids and credits line, this has increased $61 million compared to previous forecasts, and this is largely due to increased projections for the homestead property tax refund and increased projections for tax refund interest payments. Health and Human Services spending is $97 million below end of session estimates. There are many moving parts within this forecast, but a significant factor contributing to that decline is lower enrollment in medical assistance basic care for people with disabilities and for families with children. Moving to the debt service line, debt service is projected to be $51 million below previous estimates, and this reduction is primarily due to lower bond interest rates on our August bond sale and lower bond interest rates projected forward than were previously forecast, as well as the fact that we had a smaller bond sale in August than we had previously projected. And then the final category is titled Other, and it just captures all the other bill areas within the general fund budget, and the spending in this category is $104 million above end of session projections, and there are two main reasons for this change. The first is additional contingent appropriations. So I first mentioned a contingent appropriation in the E12 education spending area. There were two other contingent appropriations that were appropriated if the FY19 close balance was above previous projections, and that was, as I mentioned, the case. So $20 million was appropriated for the disaster assistance contingency account at the Department of Public Safety, and $13 million was appropriated for transit operations at the Metropolitan Council. And then the second driver of change is $71 million in unspent appropriations in fiscal year 19 that carry forward into fiscal year 20. Most appropriations cancel at the end of a biennium, but certain appropriations do have authority to carry forward beyond the biennium. So the two most significant pieces of that carry forward is $32 million for the business and community development programs at DEED and $23 million in operating appropriations for the legislature. So moving to the next slide, this returns us to a view of total revenues and expenditures in the general fund, and this slide provides the first look at the planning estimates for fiscal years 22 and 23. You can see in the first column the available balance of $1.332 billion in fiscal years 20 and 21 that we've been discussing. What I want to point out is that in the presentation of fiscal years 22 and 23, we assume that $1.332 billion in available balance in 2021 is carried forward. So what that means is that it is part of the $4.164 billion beginning balance shown in 22-23. So that's the top number in the 22-23 column. So that assumes the $1.332 billion carrying forward. So the important piece of that is that the $1.919 billion that's shown as an available balance in 22-23 is then also assuming that that money is carrying forward. So we provided on this slide a balance without carry forward, which removes the impact of that $1.332 billion from that balance. So that's the $587 million that's shown on the slide. The other point that I would like to mention here is that we often talk about structural balance when we look out into our tails or planning estimates for fiscal year 22 and 23. In the last forecast, we did not have structural balance in 22 and 23. In this forecast, we do. And what structural balance is it's looking at just the revenues and spending in that biennium without the impact of carry forwards and contributions to the reserves. So this is looking at $51.477 billion in forecast revenues and comparing that to the $51.257 billion in spending. So comparing those two numbers, revenues do exceed spending, but it's by a narrow margin. It's by $220 million. So there is structural balance projected for 22-23, but it is $220 million. So moving into the box that details the reserves, you can see that the budget reserve is declining in fiscal years 22 and 23 by $491 million. And this change is due to a law passed last session that reduces the reserve by that amount. This was done at the end of session to ensure that the planning estimates in 22-23 were balanced. So even though we have reached the reserve target in fiscal years 20 and 21, we will be below that target in 22 and 23. The cash flow account stays at the $350 million. And then moving to the stadium reserve line, this line shows that the reserve is projected to grow to $248 million by the end of 2023. And the growth is due to continued increases in projected gambling revenues, along with the fact that in fiscal year 21, the state begins retaining sales tax from the city of Minneapolis to pay for their portion of obligations for the stadium. So returning to the balance without carry forward number and the available balance for 22-23, I want to highlight here that reduction of $491 million in the budget reserve is contributing to those balances. So if the budget reserve is restored to the 20 and 21 level, that does reduce the balances available in 22 and 23. And then lastly, we include an estimate of inflation on this slide for fiscal years 22 and 23. And this is to give a sense of the cost pressures that exist in the planning years. Inflation is generally not included on the expenditure side of our forecast. There are some components of the forecast that do include inflation when there is a formula that has an inflationary factor, such as special education, or when there are programs that are paid out based on cost, and there's some of those within the Health and Human Services space. Debt service also includes inflation in our debt service payments. But for most of our general fund spending, inflation is not included, so we do provide an estimate just to give a sense of those cost pressures. And so the estimated inflation, and this is just applying CPI inflation to 22 and 23, is $1.2 billion. And now I'll pass it back to Commissioner Frans.
Well, as Dr. Kalambokidis described, this forecast is an indication of Minnesota's strong economic fundamentals, but I would not be a thoughtful budget commissioner if I failed to mention that we need to be careful in planning and our decision-making to ensure that we maintain budget stability going forward. There are three considerations that I want to keep in mind as we think about approaching the next legislative session. Number one is the budget reserve, number two is the capital budget or the bonding bill, and number three is inflation and long-term budget stability. Minnesota has established budget stability as a cornerstone of our fiscal policy, and maintaining adequate revenues, monitoring our spending, and prioritizing the budget reserve all support our state's budget in the event of an economic downturn. As of today, the budget reserve is full. As Budget Director Reitan described, during the last legislative session, the final budget called for the withdrawal of $491 million from the budget reserve in fiscal year 2022. This withdrawal was done to maintain budgetary balance for the 22-23 biennium, but with today's forecast, we now have sufficient budgetary balance to return the $491 million to the budget reserve for its intended use in the event of an economic downturn. In the capital budget area, since the February forecast, rating agencies have again rewarded Minnesota for governing in a fiscally responsible manner by reaffirming our AAA credit ratings. Being a AAA state allows us to borrow money at very low interest rates to invest in our infrastructure. For example, taking care of our aging buildings across the state. Minnesota continues to be recognized by the rating agencies as having a moderate debt burden. Compared to other states, if you look at our total state debt and compare that to the total state personal income, which is a measure that a number of agencies use, this represents a relatively small share of state personal income in Minnesota. In fact, Minnesota ranks right in the middle among all states for total debt as a percentage of total personal income. If you look at debt service, which is the annual debt payments we make out of our budget, if you look at debt service as a percentage of state revenues, that is also low. In fact, Minnesota ranks in the top 18 states for having a low debt service number. So at the same time, rating agencies generally view underinvestment in a state's capital needs as a growing credit risk. With this in mind and our very low interest rates, now is the time to invest in Minnesota. This forecast shows that we can afford a robust bonding bill, and I look forward to working with the legislature to pass a bill that will benefit our children and grandchildren for years to come. The most important part, though, of a bonding bill is not the final total, but the deserving projects that individually make up that bonding bill. And in the inflation and long-term fiscal stability, because our state only factors inflation into some parts of our budget, as Budget Director Reitan described, agencies must account for inflation in their agency budgets. As a result, the next biennium, we have about $1.2 billion of unaccounted for inflation. Inflation is real, and we all need to keep this in mind as we make budget decisions to ensure that we maintain long-term budget stability. Now remember, though, this is a snapshot. Today's forecast is a snapshot in time, and there's risk to this forecast. And we know that the forecast will go up or down in next February. So we also need to be careful and cautious until the February forecast. Let me conclude by telling you why we chose the Minnesota Marathon for our cover. You should know that there's a lot of effort that actually goes into deciding how to pick the cover picture. I won't describe that process because it's really difficult to do. But we chose the cover of this year's November forecast to be the finish line of the Twin Cities Marathon. Not only does this symbolize this state that as a state we have successfully met our goal to adequately fill our budget reserve, but fiscal stability is much like training for a marathon. It takes hard work, dedication, focus on fundamentals, and striving toward a long-term goal. For budgets, that means maintaining adequate revenues, monitoring our spending, maintaining our rainy day funds, and an unwavering commitment to sound fiscal management. Finally, congratulations goes to Minnesota, because it's Minnesota that really that have worked to make this rainy day savings fund target reached. So congratulations, Minnesota, and we'll all take any questions that you have. The governor will follow us when we're through with questions. Yes, I'm sorry.
I did have a question about, Dr. Kalambokidis mentioned the net migration that was unexpected in 17 and 18. Can somebody elaborate on how much that is?
Yes.
It sounds like it was unexpected. Why do you think it was? And has there been any discussion on the potential impact to the census?
So the question is about the net in migration, and so the year I cited as being a high point was 17, although it was high in 18 as well. And so what changed was domestic net migration turned positive. So that reversed the 15-year trend of Minnesota on net losing people to other states. We've had a positive international in-migration for a long time. And so for a long time, that positive international in-migration made up for the negative domestic in-migration. And having domestic immigration turn positive was super helpful at this point because our international migration has gone down. And that's true nationally. So that's a national phenomenon, not a Minnesota phenomenon. So it's great to be getting people from other states. The order of magnitude was in 2017, it was an additional 24,000 in migrants. That doesn't tell you much about the census, though, because the census is about the total population, and most of the population change is driven by natural change, births, less deaths. So you'd want to look at that whole picture if you wanted to get some ideas about the census. Why did it happen? We don't do entrance interviews or exit interviews with people who are coming into or leaving the state, but having a lot of great jobs available here, having wage growth increase here, and having a very tight labor market, all of those things are consistent with both the increase in the labor force participation rate we've seen over the last year and this change in people coming into the state.
Up on that too, and contextually, we're outperforming surrounding states in the Midwest in terms of bringing workers. Can you explain that too, and why we're differing from those states?
So we are an outlier in the Midwest. Indiana also has a positive net domestic in-migration, but it's much smaller than what Minnesota has. So what makes Minnesota different from some of our neighboring states? We have a more diverse economic base than some other states in the Midwest, meaning that our employment is distributed across industrial sectors at roughly the same pattern or rates as the US. So that makes us just about as diverse as the US economy. And so that's one of the issues, one of the positive factors for Minnesota. Another is a large number of corporate headquarters per capita in Minnesota. We're called a corporate headquarters state, and that's helpful both for attracting people because there are good jobs at corporate headquarters, but also because those corporate headquarters are spread across a diverse number of industries. And so individuals we have a pool of managerial talent here who can move among corporate headquarters in different industries. So it makes it easier, I think, to attract talent, but also to attract people who are parts of two-earner couples. So that if you're a corporate recruiter and you're trying to recruit talent, that person can assume that their partner might be able to find a good job here too.
And that is statewide too. That trend wasn't just in the Twin Cities, but there was reference to greater Minnesota as well. So
the population change is just Minnesota. Total Minnesota. I don't know about population changes within the state, if that's the question.
I thought somebody referenced job growth, not just in the Twin Cities, but also
the job growth
Minnesota,
for sure.
Yeah.
So
yeah.
the ratio of unemployment to job vacancies that's less than 1, that is true not just in the metro, but in greater Minnesota too. And that's something that changed in the last couple of years as well. Having that ratio be less than 1 in both regions. Of course, there are pockets where that's not strictly true. So there are details that are different when you look below the surface, but yes.
It sounds like you'll know within the next 10 days whether this forecast stays on course or if the December 15th tariffs do or don't come on. I think you say in here that there's more upside risk upside potential in the forecast if the tariffs aren't imposed.
So what I said was that the trade policy uncertainty, so not knowing what's happening with tariffs and having trade policy change, is a source of drag, particularly to business investment, so a source of drag to the economy. So the upside potential would be if trade policy uncertainty went away, if we actually had a clear playing field about what trade policy was going to be. I don't think the single aspect of the December 15th tariffs is enough to reduce that uncertainty completely.
Commissioner Frans, you said the state can afford a robust bonding bill. How much is too robust? would $3 or $3.5 billion be too robust? And if that is, what number would you feel more comfortable with?
Well, you know, the size of the bonding bill is always a subject of much debate. I think one of the things that we've learned this year, the governor, as you know, has been really active in going out and looking at bonding projects himself, as well as we have at MMB. We've tried to do a job to make sure that the bonding bill is representative of everyone across the state. So remember, we had over $5 billion in requests. So how do you pare that down to whether it's $2 billion or $3 billion? How do you pare that down? That's difficult. And one of the things we also added this year was a website for local communities to give their input about their local projects so we could do a better job of assessing kind of what needs to be done at the local level. But I think that the decision about the number, let me just give you one number. A $2 billion bonding bill would cost, debt service would be about $180 million for the next 3 years. It's a little bit lower than normal because we're in the second year of a biennium. So anyway, so that would be the cost of that. So the question really is this the right time to leverage $1 billion or $2 billion, whatever that number is this the right time to leverage that money by borrowing borrowing funds at 1 or 2%? We got incredible rates in our August sale this year. So, you know, I don't know what the right number is, and I don't think we're ready to say what that right number is. I do believe that our commitment is to making sure that we do a bonding bill that takes care of needs around the state. We look at, you know, children and families. We look at education. We look at clean water. We look at investing in communities that need help to get things done. So, you know, this is the favorite part of the job is working on the bonding bill to determine where we invest. But I just think we're not ready yet to say what that number should be, but we want to work with the legislature to make it a robust bill.
Cash for bonding, what's the trade-off there for lawmakers?
Well, you know, cash is precious, right? And when you have cash, as a former tax lawyer and a business operator, you tend to invest in capital with borrowing because you can leverage your money. You can, by Minnesota taking a $1 or $2 billion bonding bill and using a debt to finance that, you can leverage the money so you only have to pay $150 or $200 million over the next 3 or 4 years. So you want to leverage the cash that you have in order to make capital investments for the long term. So I think cash for bonding is not the preferred route, and there are some cases where we can't bond because of certain legal issues and we have to use cash in that situation. But generally, long-term investment in long-term projects is really done through borrowing.
Have you guys said how much of this 1.3 is structural versus kind of a one-time drop in the bucket?
Yeah, the question about whether the $1.3 billion surplus is structural or long-term, you can see as Budget Director Reitan described the small structural balance that we have with revenues and spending. You can see that it's mainly a one-term asset. And we've had this situation before where we have a large or available budget balance in the current biennium and none or very little in the next biennium. So what we're seeing is we're generating some one-term monies that we need to be careful about how we invest those for the long term. So we do view that as a really one-time money in 20 and 21.
Another reversal in trend appears to be household formations are finally up. We've been talking for years and years about those being down, maybe in relation to college debt. Do we know why new households are forming?
My family hasn't contributed to that.
It goes the other way. That's right. So household formations did not recover from the Great Recession as quickly as was expected. And so you're right, we've been looking for that to happen. In Minnesota, the spike in household formations happens to coincide with an increase in net domestic immigration, so that might be part of it. But it's also the case that household formations tend to increase when the economy is doing well and when good jobs are available and when wages go up. And so that, I haven't analyzed it, but it's consistent with that story as well, that when the labor market is tight and offer wages go up, that a household is formed when people who had been living together live separately. So for instance, when your kids move home with you, when your college-age kids move home with you and they get a good job and they move out on their own, that's the formation of a household. So it's what you would expect in a growing economy.
Do you think the number was significant? Wasn't it like the 30,000 range?
It was significant because, and it was more in line with what we would have expected coming out of the recession, but we had these low years. And so it's welcome because there also perhaps is some pent up demand for that household formation, some postponement that we might be seeing now.
Do you have the figure for the 2018 net migration, and do you have any indication if that's appears to be continuing in 2019, and are you projecting this to continue this upward trend?
I don't have the 2018 number off the top of my head, but we do, that number was also robust. It just wasn't as high, I believe. This forecast does not assume that population growth at that rate, or that immigration growth at that rate necessarily carries forward. So if it does carry forward, then that's some upside potential to this forecast.
You haven't mentioned tax cuts as a factor in the economic growth. How do you calculate that?
Which tax cuts are you specifically
federal
asking
and
about? So the federal tax cuts are apparent in the US history. So you can see the increase, sort of the above average growth in 2018, that 2.9%, that was fueled by the Tax Cuts and Jobs Act. And you can also, I don't have the investment one, but in business investment in particular, there is a spike there. For Minnesota's tax cuts, the trend in growth in wages, growth in personal income, steady employment, those are all trends that started well before, further back in this expansion. And so I don't see an inflection point at this point with regard to the Minnesota tax cuts.
Thank you. Thank you for listening to us. I think we'll turn it over to Governor Walz at this point, and thank you all very much.